whether we are still in a crisis or whether the danger is over. And I've got an expert panel with me of editors to discuss that. So we have Paritosh Bansal, who is in New York and is our global finance and markets editor. We also have here in London with me, Elisa Martinuzzi, who is finance and markets editor for Europe, Middle East and Africa. I have in the US, I have Dan Burns, who is our US economics editor. And finally, I've got in Mumbai, all the way from Mumbai, we have Una Galani, who is the Breaking Views editor for Asia. So the first question, I guess, to get us going will be to Paritosh and to ask him, well, how did we get here, Paritosh?
Thank you, Mark, and good morning, afternoon, evening, everyone. Well, let me sort of, it's a sophisticated audience, I believe. So let me sort of give a 36,000 view quickly. I think starting with the Fed and interest rates, in very short order, we have gone from more than a decade of cheap money and low interest rates to an economic environment where rates have risen incredibly fast as the Fed and other central banks have tried to rein in inflation. And whenever that happens, people who are stretched and took unwise risk tend to get exposed, and we start to see such meltdowns. So if you sort of look over the past year or so, we have seen a series of dominoes fall. The SPAC bubble burst, the crypto market collapsed, tech stocks went into a meltdown last year. We saw the UK government bond crisis. We saw real estate funds, such as the Blackstone REIT fund, see large outflows. And to me, the regional bank crisis is sort of part of the same continuum, and that's where we are. And specifically in the case of Silicon Valley Bank, I think the rising interest rate environment kind of hit it both on the liability side and the asset side of the balance sheet. On the liability side, as rates started to increase, the startup clients that it had, which had access to easy funding till maybe a year, 2 years ago, didn't have that anymore. And they started to kind of withdraw money to fund operations effectively and weren't really putting new money in. And then on the asset side of the balance sheet, the value of the investment portfolio that they had fell as rates rose, with Treasury securities and agency MBS and others falling in value. And as a result, the bank was forced to sell investment securities at a loss. And once the market sort of got to know that, you saw one of the most spectacular bank runs in history. I mean, to me, the number that really sticks out is that in one single day, it was like the Thursday before it fell, some $42 billion were withdrawn from Silicon Valley Bank. No one really can survive something of that magnitude. And when something happens with such speed and scale, confidence quickly erodes in markets. We've seen that in previous crises. And anyone else perceived to be weak starts to see counterparties pull back really quickly because nobody wants to get stuck in the wrong side of the trade. And that leads other institutions getting into trouble. And then obviously the weakest ones are the first to fall. And so when Silicon Valley Bank kind of happened, I think it set in motion all those forces that week. Investors started to look at other banks with similar characteristics and potential losses that were hiding in their books. Depositors withdrew billions because nobody wanted to get caught in the same situation. They moved money to institutions deemed safer. Just this Friday, we saw some of the biggest beneficiaries of that. JP Morgan actually saw the amount of deposits increase while the industry-wide number fell. And then, in Europe, we saw Credit Suisse, which had been sitting out there for months as one of the weakest global banks, get into trouble and eventually had to be rescued. So that kind of is sort of what happened in short order.
Okay. And so where are we now then, Paritosh? Seems to be some debate about whether the danger is over or whether the next big shock is coming.
So I think it's an open question a little bit to me. The crisis definitely has eased. We are no longer where we were in the middle of March, right? And you sort of see kind of some of the indicators that were out there, and we can get into it more during this conversation, have sort of eased off quite a bit. But then at the same time, if you were to think that the interest rate environment was fundamentally what was causing it, we're not out of the woods yet, right? Like, I mean, if you look at the great interview Dan's team did yesterday with Bullard, he kind of was taking the other sort of position of it, like saying the economy is still pretty strong and the labor market is strong and what recession, and we're going to raise rates. And if that keeps happening, then the pressure sort of higher for longer kind of an environment keeps there. Then all this pressure that kind of caused the March banking crisis kind of stay in place, and you would sort of see other things blow up, right? So I mean, in the in earnings season so far, like there's a lot of people talking about office real estate, for example, and there would be other things that sort of took risks or areas that get exposed.
Yeah.
So I don't think we're out of the woods yet.
Okay. What do you think, Dan? It doesn't seem to be preoccupying the Fed or indeed other central bankers much these days. What's your view?
Well, I would disagree that it's not preoccupying them, right? In fact, the Fed is in the middle of a big review about what went wrong that it's going to release on May 1, the same week, just a day before policymakers sit down in Washington for the next 2-day Fed meeting, which they're likely to raise rates by 1/4 point and put us up above 5% for the first time since the mid 2000s. And what that speaks to is that they've to some degree reached a conclusion that the primacy of inflation remains intact as their central focus for monetary policy. And that the episode of a month ago and their response to it with the creation of the new bank term funding facility program, more generous terms at the for collateral treatment there, and also at the discount window, showed that they have tools that they can apply to each circumstance distinctly. So you have financial stability, which is very much a part of the Fed's, mandate, right? And they use tools they, at this point, for now, believe remedied the circumstance. But inflation is not going away. There is some indication or some expectation, no indication yet, I would say, but expectation that there's going to be some natural credit tightening that occurs outside of their own interest rate hikes as a result of what happened a month ago. And that may begin to do some of the demand destruction that they are looking, they've been working to foster over the last year, for them. Now, whether that means, you get to 5.1, 5 to 5.25% as we expect on May 3rd, and there is a signal to pause, or whether they leave cards on the table and say, let's see how things play out. There's a very, very active debate, as you've seen over the last few weeks in our own interviews, as Paratosh alluded to with James Bullard from the St. Louis Fed yesterday, Raphael Bostic from the Atlantic Fed last week, the Atlanta Fed, and others. There is a divide opening about those who really would like to continue pushing ahead. They do have confidence in the strength of the economy, even though they do expect it to weaken. But against others who are, Austin Goolsbee, the new Chicago Fed president, is probably the most dovish out there, saying it is time to take stock after we do this next month.
So what's your hunch, Dan, in terms of that review of the collapse of Silicon Valley Bank? What are the lessons to be learned, do you think? What's that report likely to say?
Certainly in terms of basic supervision, when I would expect that there's going to be, and we haven't reported this out yet, but we expect that there's going to be some measures taken to address intransigent banks. This is a bank that had been given a series of warnings about its behavior and was effectively non-responsive to each of those, but it was allowed to continue taking in deposits at a meteoric rate and well above the level of insurance. So whether that ends up being recommendations for a quicker reaction time when you do appear to have a rogue bank, effectively is what this was, to be able to clamp down on it more quickly. There's a huge debate to be had, and it's probably outside of the remit of the Fed and the FDIC, which will also release its own examination of what went wrong. They can't do this unilaterally, but there's a huge question around the $250,000 insured deposit limit, and whether that needs to be applied broadly. There has been stabilization in deposits. So about 300 billion, a little more than 300 billion deposits left the system in the 2 weeks through March 22, those crisis 2 weeks. And about 117 billion have come back in the 2 weeks since, according to the weekly H8 data we get, the big aggregate banking aggregates we get. So there's demonstrable data that shows that the outflows have stymied, have stabilized. But we've also, as Paratosh pointed to, a certain, you don't know where the next rock will turn over, and there will be another online bank run of more than $40 billion in 24 hours. And I think that's what's keeping them awake very much at night. I remember in 2008, I was a Wachovia customer in the middle of October, 2008, and out walking my dog in Newtown, Connecticut. And there was a line of cars at the Wachovia ATM on a Saturday that stretched for half a mile down the road waiting to get in. That was very visible. I didn't have 250K at the bank then, so I was pretty confident that I was okay. But this all happened invisibly, right? Completely, all electronically. So there's also questions about the Fed response, right? The discount window right now is only open during normal, kind of the day, right? Should the discount window be open overnight to be able to react to deposits that are leaving at 1 o'clock, 2 o'clock, 3 o'clock in the morning? If depositors can pull that way, why can't a bank go to the Fed and expect it to be open to help it? So I think that's so there's some things there that
some 24-hour. Sorry, Paratosh.
If I can just jump in there, like one interesting sort of fallout of this, there's still about 140 billion or so in support that the Fed's giving the banking system, right? So in terms of whether we are out of it or not, that's kind of fairly extraordinary still, right? It's down from the peak, but extraordinary. The other question around sort of how much of the banking system, what should be the insured deposit level, would also have really long-term implications in terms of the asset deposit, asset liability gap on bank balance sheets, with sort of implications for, valuations for MBS and other securities. So that kind of a debate as well, where they go in terms of regulating banks, but then what of the response comes in there, what could really change the landscape here. So I think it's also kind of set in motion, again, a whole series of things which will kind of fundamentally alter where the economy and the banking system is.
Totally. I want to bring in Una and Elisa into this question about where we are now. Are we still in some sort of latent crisis or what? So Una, we were talking before this presentation. There was actually a good sign from Asia today with, I think, Sumitomo Mitsui issuing some hybrid instruments. Una.
Yeah, I mean, look, I think this has been a really big sign, confidence and risk appetites are back. Sumitomo, as you said, it's a Japanese bank, became the first major bank in the world today to issue an AT1. It's a $1 billion issuance. So that is a positive sign. And it's interesting that's coming out of Japan, because the knock-on effects of the direct hit of the banking crisis in Asia have been pretty limited. But where they did really strike was in Japan, and it was the Japanese banks that took a hit because they're the ones with the large foreign bond portfolios. But that worry has also really subsided. And, Asian owners were also big, Asian investors were also big owners of the Credit Suisse AT1s. MUFG's clients took a $700 million hit there. So the fact that we've got Sumitomo coming out with this AT1 is very interesting. In reality, will the European and the US AT1 market recover as quickly? Not so sure. I mean, to be honest, I think the Asian market may be a bit more bullish on that front. But, we haven't really seen the sort of wider bank sell-off that you saw elsewhere. Generally, I think in this region, banks are seen as more solvent, as having better liquidity. And many of them are kind of, government-backed. So, I think mixed signals here as well. To Dan's point, I think central banks here are also worrying a little bit. We've had Singapore, India, Australia all pause on their rate hikes. And I think, Singapore and India definitely sort of referred a lot to financial stability. And they're quite concerned about what the tighter financial conditions will do. And they're expecting those to really intensify in the quarters ahead.
Interesting. I want to bring in Elisa too. Elisa, what's your take on this?
I think a few things. I think if you look at some of the market stress indicators, and if you look at the bond market volatility index, and if you look at the stock market volatility index, you would think there's nothing to see here. It's all over. You're back to lows not seen in months in some cases. European shares, shares of European banks are sort of up, 10% or more from their lows. But I would probably draw us back to Paratosh's initial remarks, which is, the context here is one in which there's been a massive dislocation in terms of the huge jump in interest rates. You also have, very high inflation up against a background of a lot of debt in the system. So the fault lines and the might yet appear in places where we still don't know, right? I mean, we were surprised by what we saw over here in the UK with, pensions. Pension funds nearer the brink when UK bond moves so rapidly. So I think that is the context in which we're in, which is the context in which there are investors tend to go risk off very, very quickly, which is what we saw with the banks and the lack of confidence. 1 minute these European lenders were supposedly finally making money, interest rates were rising, the wind was finally in their sails. This was going to be their year. Let's not forget, in February, this was going to be, European banks' year of finally making money on the bread and butter of their business, which is, lending money. That's how quickly sentiment changed. And I think that's a reflection of the context that we're in. And so if we park the banks for a second and we can delve in more detail into how strong or the banks may be from a capital and liquidity standpoint, you also still have a lot of unknowns in the non-banking financial sector, right, which is what the regulators increasingly warn on but haven't done much about, right? We don't know where those risks lie. Particularly the concentration of those risks, because it's not, that's where we could be caught out. And it's interesting, I was speaking to a European banking CEO about sort of the very sort of, stressful days around Credit Suisse. And they were like, actually, compared to the global financial crisis of 2008, I was quite relaxed because the person said, they could look at their screens and they knew exactly what exposure they had to Credit Suisse. But again, this is points to the fact that they're very comfortable with what they know in the banking industry, and that regulation has forced a lot of more of that business to become more transparent, to go through central counterparties. But I think the degree to which we don't know what where that risk lies in the non-banking financial sector could still catch us out, and that's in addition to the bank weaknesses that they're still facing. And I think Paratosh touched on the real estate sector and the exposure to commercial real estate in particular. I think the numbers point to the European banks having a much smaller exposure to commercial real estate than the US lenders. But again, some of the analysts point to the fact that some European banks are actually very heavily concentrated in commercial real estate. So you really have to dig deeper and beyond the headline figures. And then you have the fallout, which we are, still not seeing yet from, the tightening of financial conditions and the impact that's going to have, the credit crunch is going to have on the real economy, and, consequently, the impact that's going to have on banks and other financial players. Don't forget that in Europe, if you take the corporate market and particularly the SME market, it's still, pretty much primarily financed by banks, right? There is not as deep a capital market. So in terms of where the banks are, yes, they are much more capitalized than where they were in the financial crisis. But there are pockets of weakness, and I think to echo the remarks from both Dana and Paratosh, the speed with which money has left, not just Silicon Valley Bank. I mean, we saw similar moves at Credit Suisse all the way back in October, right? That's when they had their mini run, when somebody tweeted, completely unsubstantiated rumor on the bank being close to implosion. And then in that quarter, that month, so tens of billions, leaving from Credit Suisse, and how we adjust for that and how we sort of prevent those types of runs from bringing down other banks? We're still not there yet. I mean, there's still no provision really, and I mean, there's talks, as the others have said, among regulators to try and look at that. But I think that's a very challenging area to tackle, and that will still be with us, right?
Yeah, and indeed, as you say, you've been covering a lot of the UBS Credit Suisse saga. Given that we've now got a much bigger bank in Switzerland, it brings the question of the stakes seem to be getting higher and higher. The too big to fail concept is getting scarier and scarier, is it not?
Yes, quite. And actually, to sort of to tackle the question, are we out of the woods? Well, one of the reasons that Switzerland says they chose not to put Credit Suisse through resolution was because of the potential of triggering a financial crisis. So that's how close we got to to a full-blown financial crisis with Credit Suisse. And yes, to your point, this does seem to sort of go against the key learnings of the financial crisis. We now have an institution that is much bigger, much greater in size than the Swiss economy, and going into a very complicated merger, right? We haven't seen a merger of this kind, of this size in the banking industry since the financial crisis. And this just juggling through that and getting to the other end is going to take years during which they'll have to be going through cost cutting and higher funding costs that we've seen as a result of the AT1 debacle, and potentially requiring higher capital as regulators look to this institution, which is now even bigger, and impose potentially higher requirements on them.
Yeah, surely a massive challenge for regulators. We might talk a bit more about fault lines and where they are. I'm getting some questions through from the audience. We're very interested in some of these fault lines in particular. Before we do that, we talked a lot about the movement of money out of banks and so on. Uno, I know you've been looking at financial centres in Asia. What's happening in terms of movement of money there amongst financial centres?
Yeah, well, to the risk we were just talking about, Elisa was just talking about I think in Asia, they really smell blood, and the bankers here really sense this huge opportunity to feast on the spoils of this crisis, especially on wealth management. I mean, Switzerland's reputation for stability has taken a big knock, but that reputation for stability was why it was the global leader in wealth management. If you combine, in theory, if you combine UBS and Credit Suisse, you get a bank of over $3 trillion of AUM, but actually you're going to end up with probably far less because the rich are looking for safer places to park their cash. People, I was in Singapore a couple of weeks ago, and people are just asking, now there's only one big bank in Switzerland. So what happens when that fails? And, with all the geopolitical tensions in the world, with Russia's invasion of Ukraine, there is a real, the new mantra in wealth management is people want return of their assets, not return on their assets. And to that extent, people are just looking for safe havens. And I think that is where Singapore is going to be a really, really big beneficiary, and Dubai as well. I mean, we think that Singapore is already called, by the way, the Switzerland of the East. We'll be watching their DBS Group, there is the biggest bank. We'll be watching their earnings very closely to see what the net new inflows look like. But, on our projections, we think that Singapore could even overtake Switzerland in terms of booked wealth assets as soon as 2026. It's growing at double digits. It was already benefiting because it's been getting money from China as well, not just from China, but from China as well. The wealth flows from the mainland China into Hong Kong have slowed down. So there's a real movement of money. And I think, just over the last few years, people have, the Asian banks are growing bigger. People are more comfortable with putting their money there. And, and as global risk has intensified, the wealthy are not just having one or two relationships, they're having multiple relationships with multiple banks. And, the Asian banks are probably not going to be also rands anymore in this race. They're going to be big leaders in what happens next.
Yeah, super interesting. I just want to turn to Paratosh now. We're talking about fault lines. What is the next big fault line, and how do you think that will play out for the
Wish I knew. I've been asking that question literally for the last year now of sources, and I can tell you that nobody said that the banking sector was probably where we'd see some issues, right? And so I think that's kind of been the question that everybody's asking, right? Like it could, like at the moment, the commercial real estate is sort of something that bankers are kind of pointing out as an area that could come under stress, like some specifically within that space, the office sector, given what's happening post-pandemic in terms of vacancies and sort of just interest rates going up, and sort of as refinancing and maturities come due, right? Like, so that would be one area, which again goes back to the point of higher for longer could also be a problem, right? If it doesn't come down, then when all those the debt starts to mature, the refinancing would be an issue. Other areas, which I don't know if there's a problem, but I think it's the lack of transparency would be a question, is like private credit markets and things like that. What's been happening there? Again, though, like it's very hard to tell whether anything systemic comes out of it, right? It could be somebody who's taken a risk, sort of is exposed and blows up, but does it kind of then cause a bunch of other things to happen is the big question. So it's very hard to say, but what I do think would happen is people are very closely watching for that next shoe to drop, and any sign that shoe is dropping would lead to, again, probably another round of sort of risk aversion and people moving out of markets with speed, right? And so I think if you look at the nature of crises and the way they kind of play out over the years, like, I mean, I lived the 2008 crisis. There was, it happened over several months, right? Starting with sort of, Bear Stearns hedge funds kind of going down, and then sort of real estate market getting into trouble. And then Bear Stearns went down, and then there was like a lull for a bit before kind of Fannie Freddie started to run into issues, and then Lehman happened, right? So how this plays out, again, kind of, I think a lot of the steps that are being taken now, what happens in May with the Fed could sort of determine whether we do have another round, or the debt ceiling crisis. That's sort of like there's external shocks that could sort of hit the system, right? That debate's going to pick up now as sort of the receipts come in and your X date starts to become clearer in the next few days, I suppose, right? Or, there's sort of the China-US geopolitical tension. So that any of the external shocks, plus sort of this kind of, with every piece of data that comes in on the economy, which kind of sets what the interest rate outlook and the trajectory from here on would be like, could kind of trigger something off. And for me, like the difficulty with this one is that because it's so wide and generalized with the generic secular pressure rising because of interest rates, where things blow up, it's very hard to tell. And to sort of Elisa's point, like, in the case of Credit Suisse, like a banker could look at what their exposure was, but then there are all these other sort of areas that have become massive in the last 10, 15 years where you don't really know what's happening. And that could take people by surprise.
And Dan, you've just spent a week mixing with central bankers from around the world. I mean, what are they talking about in terms of the weakest link in the financial system now?
Well, I think the lesson of the last month is the weakest link is never where you expect it, and sometimes it can be where you were just literally bragging about things being the best. The collapse of Silicon Valley Bank happened less than 48 hours after Jay Powell had spent 2 days sitting before Congress and fielding a lot of questions about, what are you doing about inflation and recession risks. But the handful of questions put to him about the banking system, he said, "Yep, we're fine. Everybody's fabulously capitalized, and nothing to see here." Of course, look what happened. 48 hours later, words he wished he could grab back. I would not be surprised. I think there's two real areas of policy missteps potentially in our near future. One is before the Fed. Does it you take May the May increase, which is effectively baked in, aside. What is both the signaling and the actions they take after that? Do they keep marching ahead and to the point where the economy does break? That's the tradition, right? And that's typically what happens. And they take it too far. The last couple of miles of the last few hundred yards of condition tightening sometimes are there but not seen for you, and you exceed that limit and things crack. So that's I think the other one, and Paratosh mentioned in passing, and I think it's actually a much more material one, is the one the real risk of around the debt ceiling, and a policy mistake that emanates from U.S. political dysfunction, and the inability to correct that before the X date, or some brief extension of that to the end of the fiscal year. Most people estimate markets between pricing on T-bills and people who track the Treasury spend and what we expect to see in the next few days in terms of inflows into Treasury from tax payments, kind of pegged that right now at about mid-August, but there could it could well get kicked to September through an agreement to have a continuing a temporary suspension to align with the end of the fiscal year, to have it be more squarely about the budget. But it is there's each of these has gone. 2011 was a hairy moment, as many recall. Cost the U.S. its AAA across the board credit rating when S&P downgraded, and eventually there was reason if you want to call it that, but a deal was struck. The precarious nature of Kevin McCarthy's hold of the speakership in the House, and him being beholden, frankly, to a clutch of generally new but very vocal and feeling very empowered House members, who don't want to see a deal struck at all. They're willing to put the economy at risk to get their way. That is a non-immaterial risk, facing us in the next 6 months. And to be honest, if I had to weigh which party was going to make the more rational choice in the next 6 months, I'd hope it would be the Fed, because I don't trust it to be Congress.
Yeah. Okay. Well, there's actually a bit there we could come back to some of that, particularly the debt ceiling, I think. But I want to just ask you just on the Elisa's point about the non-banking financial sector. Are central bankers watching that, and what parts of that are they watching in terms of the informal financial system? Is it something that keeps them up at night, Dan? Do you know?
Oh, sorry. I thought you were going to Elisa. Sorry, you were going.
Oh yeah, no.
I'm sorry.
It was just a quick comment on Elisa.
Absolutely. If you look at the monetary policy report that the Fed submitted just as Powell was speaking, ahead of his appearance on the Hill, non-bank financial sector, the lack of transparency, it's a concern, and certainly when you see some of the deposit money moving in that direction out of banks that were either perceived as at risk because of what happened with Silicon Valley, or just frankly weren't paying enough on the paying enough basic interest to depositors, so people are taking money goes where it's treated best, right? So it's looking, in a lot of cases, it's looking outside the regulated banking sector. So those that risk is definitively increasing. But it's they also lack a lot of visibility, and they lack a lot of tools to address that directly. Certainly in the United States, statutorily, there's not a lot available to them.
And Elisa, are you looking in particular one part of that non-banking system?
I think to Paratosh's earlier point, we just don't know where that next shoe to drop might be. I think you've seen, just over the last, couple of years, we saw Archegos blow up and, have a knock-on effect on some banks. We saw, pension funds. Who would have thought pension funds would be, nearing the brink? The repercussions of that sector would mean, it doesn't, bear thinking what that would have been like if that had, if that hadn't been resolved with the Bank of England stepping in. So I think it's hard to pinpoint. What we do know is that a lot more has obviously shifted away from banks, which is great for banking stakeholders and not so great sort of in the first order, but we just don't know about the second order effects. I'm not quite sure we can really pin it down, and I think the lessons of the last couple of years show us it could literally be anyone.
In that vein too, there's been sorry, go on, Paratosh.
If I can just add another point to this debate, right? I think one of the things here also is important to think and not be all doom and gloom about this for a change is that it's the potential of blow up, but equally important is what the potential of ripple effects from that whatever that blow up is, right? So I think it is the contagion effect almost that's kind of more important in some ways from a financial systemic stability perspective than the blow up itself, right? So I mean, for example, like if you look at what happened with Blackstone's REIT, there was a huge, and I think there still is like a pretty massive redemption demand, but then they just put up the gates, right? And so it was terrible for people who invested in it, but then there was really no knock-on effect as such that kind of started to shake systemic stability, right? The same thing happened with the crypto blowout, right? Like, I mean, this is my favorite thing. Like, it kind of went from any other market, you go from 3 trillion in market value to $1 trillion, like it would be devastating for financial stability. And it was like a tree falling in a forest in a way, right? Like, not to kind of simplify it too much, but I think one of the things as we're kind of looking at where sort of, and I think that's where the transparency question also comes in, is the exposure, right? Like, we don't know what might blow up and who's kind of overextended, but then who else is exposed to the person who is overextended, right? And so I think in some ways, like, one of the arguments I've heard against sort of a lot of risk really mattering in the non-bank financial system is that, it's more discrete, right? It's not in the banking system where you have so much more counterparty risk and like if a major bank fails, then you have like absolute pandemonium. But like in that case, okay, if a major private equity firm or hedge fund or something collapses, it's a little bit more contained. And even in the case of Archegos, like there was huge losses and it eventually did take Credit Suisse down, but it was contained, right? Like there was enough capital in the banking system to actually absorb that. So I think like that's the kind of also the issue here is like you don't really know what the knock-on effects would be if something like that happens.
And you don't really know where it starts actually, because I mean the Blackstone BREIT example you use is really interesting because actually a lot of the redemption started in Asia because people had to meet margin calls for issues that were entirely unrelated to what was going on in real estate. But then that sort of just hit a nerve and then it just continued. And they're in their 4th consecutive month of redemptions, right? So they still got the gates up.
And you saw that in the UK too, right? The UK real estate funds started gating because pension funds were withdrawing money because they were losing money on their UK bond portfolio. So yes, it's that knock-on and domino. And just speaking of transparency, I know it's not one we've touched on, but one of the sort of the stress factors that emerged in the last couple of months rather, in the European banks were the big swings in credit default swaps and the big price moves there. And again, since the financial crisis, you've had most of that market now shift to central, to go through central counterparties. So, the industry is saying, well, there's nothing to see here because 85% of that market now happens through central counterparties. But what do you know? That it's only 15% that's not transparent, and yet it had massive implications for European banks that showed, so their shares moved because their CDS moved. So the transparency, even if it's, unfortunately, even if it's a smaller part of the market, can still have significant effects.
So plenty to be worried about. In fact, Una, what some of the questions that I'm seeing here are concerned a bit about China and just what is the situation with Chinese debt and whether we should be worried at all about that.
Yeah, I mean, it's a great question. I mean, obviously, we've had some good economic data out this week. It looks like we're kind of off to a strong rebound, a good start to a strong rebound, and China looks like it's on track to hit its 5% GDP target this year. And so it's going better than anyone expected. But it's sort of really interesting that the Chinese indices didn't really move up much yesterday on that data. And I think that really points to the fact that we have to see how sustained that recovery is. It came off a low base. So, while property, which, drives a quarter of output in China, is stabilizing and property sales are up, investment and construction starts are still down. We still have Chinese consumers hoarding savings. There are still questions about whether China needs more stimulus, whether they need to have direct handouts going to consumers. I mean, China may wait now before doing any of those things because they've got this reprieve with some good data. But the big unknowns in China are still there, and China has its own share of debt problems. The problem at the local government financing vehicles, there's $9 trillion of debt there, half of GDP. A lot of that is soured. Some of that is offshore. That is a pillar of China's debt market, and a bailout of that is going to be very expensive. Letting them default threatens China's credit worthiness. So it's like stuck between a rock and a hard place. It bears a lot of the same problems that we saw with the real estate sector and may have to be worked out in the same way. China is also in the grip of this really quite scary growing crackdown on the financial industry. And that is a really, really big unknown, because we've seen bankers disappearing and turning up, helping the officials with their investigations. Obviously, bankers' salaries and headcount is all being slashed. Regulators are under scrutiny. And, this is sort of Xi Jinping's focus on excessive wealth is really now bearing down on the financial sector. And that's problematic because the financial sector is the one, yes, it can be reckless, and there's probably very little sympathy in the world for overpaid bankers, but you do need bankers to be able to act with some degree of confidence, to be able to come together, and the financial system to be able to act with some degree of confidence, to come together to solve these other problems. Restructurings do not happen by themselves. So to the extent that is also a big unknown and sort of hovering over everything. I mean, the danger is if Xi's crackdown on the financial industry goes too far, you could have a situation where the financial industry there freezes a bit too much. And that could not be very conducive to, China's economy holding up well for the rest of the year.
And do you think China could become a source of global financial instability one day? It does seem to run its own race from a financial system point of view.
Yeah, well, I mean, China does its own thing, and that's why it's sort of counter-cyclical. It's sort of, and it's doing that at the moment. I mean, global source of financial instability, I think that there are problems with offshore debt that need to be resolved. I think the problem is a problem that is primarily a Chinese problem, but how that impacts its economy and then its own growth engine and how that propels global growth, I think that can become a problem. Many Asian economies, the poorest countries in the world who are all struggling to work out their debt, they're really depending on China's growth engine, to sustain them economically. So I think, I see it sort of more in that light than in the former.
Okay, I wonder. Sorry,
can I just add another point in there? Like just in terms of like another sort of unknown there is kind of geopolitics here, right? Like, I mean, I think the US-China sort of tension, the fallout of that is kind of equally sort of important. I've spoken in the last week, 10 days, to at least two people who've just been to China. And one was this head of a private equity firm. And, I mean, his view at the moment was, look, we'll kind of, the policy in the US is, tall fences around small gardens. And so if you can sort of, it's fairly sort of focused and you can sort of avoid that, you're fine. But then in the near to medium term outlook, how do you kind of think about your presence there? He said he just doesn't know how to frame that question yet, right? And so there is that sort of one uncertainty about what the medium to longer term engagement engagement with China is going to be, right? And how do you kind of navigate that, and as an investor or as a corporate, right? And then I think the whole reshoring debate that's happening, like, would also be inflationary to a significant level, which I don't think is fully kind of baked in yet, right? And so I think the combination of those two things are also, in addition to what Una was saying, would kind of determine where we get to in the next few months.
And that China, that cooling of sentiment around China is, from the global investors, is very real. I mean, the hedge funds are still coming into China. The sort of money that can come in and out quickly is sort of coming in and out quickly, but the foreign direct investment, that's really crashed in China. One of the big private equity firms was telling me that, they are seeing all the investments into Chinese private equity is coming down dramatically, because these are kind of 5-year, 10-year funds, and people don't want to lock their money in for that duration in China at the moment. So I think there's people who, and the big sovereign funds and the endowment funds who are investing in Pan-Asia funds that then invest into China are sort of saying to the general managers of those funds, China's fine, but don't go too deep into it, because, we really don't know what's coming down the pipe. So a little bit of China risk is okay, but too much, we don't want to see that.
And staying on the geopolitics, one more thing to point out is, of course, China not only plays a big role in terms of the economy and its pull, but it's also a major player at the table of many sovereign debt restructuring, right? And we have 12 nations around the world in distress at the moment based on their debt, and we've got China at the table on a lot of those, and the geopolitics is obviously playing a role in how those discussions play out. And more geopolitical tension could lead to more fragmentation in global financial markets, which might in of itself be a concern for financial stability. Obviously, that doesn't happen overnight, but it's still certainly something that will be with us certainly for the foreseeable future.
Yeah, it's really interesting. China did go to the sovereign debt roundtable talks in Washington last week, but and they were sitting at the same table as the IMF and the World Bank. But in reality, these two camps are still like poles apart, and they really agree on very, very little. It's been almost 3 years since Zambia defaulted. There's still no consensus between the West and China on how to restructure these debts. You said 12 countries, but I think the IMF says there's like almost 60 now in debt distress or close to debt distress. So all these countries, poor countries, Zambia, Ethiopia, Sri Lanka, they're kind of all completely held hostage to this standoff, which is as much about debt restructuring as it is about China's desire to have more influence over these multilateral institutions. And we've talked a lot about transparency here, but we still don't have transparency clearly in terms of China's debt. We still don't have a full picture of the extent of its debts to the developing world. Countries are now being asked, these poor countries are now being asked to disclose which of their debts have non-disclosure clauses written into them by China, which is just amazing. But the stakes here are very, very high for Beijing. On the one hand, you could say, well, they're just a financial creditor, and all financial creditors play a really hard ball game. But, China has spent $1 trillion to expand its influence across Asia, Africa, Latin America through its Belt and Road project. And the numbers, a number came out this week, it's from the Rhodium group. They basically reckon that China's got renegotiated or written off about $80 billion of external lending in 3 years. Where do those losses, if they have to crystallize them or more of them, end up? They may end up with the banks, and the banks aren't in the best shape. So, China is very, very much another big unknown here.
Dan, did you want to jump in here? I know you've been dealing with this issue as well, the IMF meetings.
Yeah, I just agree. I mean, it was as central. Was probably one of the two big pillars of the conversations at the IMF World Bank meetings last week, aside from the bank issues and inflation. And that is, whether this process, there'd been some reports that China was willing to give a little bit of ground on its demand that the IMF and World Bank, the the multilateral development agencies that are the lenders of last resort or providers of below market credit when should be exempt from taking the haircut that is expected of the bilat lenders, right? And China is the largest of those. We left, all of those finance ministers left Washington last week with a promise to try to speed along some of the administrative processes that begin, at the beginning of these things, like debt sustainability analyses and other things, but no concrete understanding of what ground, if any, China intends to give. And
also, to be clear, sorry, Dan, like if China even does drop that demand for multilateral institutions to share the write-downs, it's really hits a nerve on the low point we've reached if we think that's progress, because it's not really it's not really, it's highly unlikely that would be an outcome.
Right, I'd agree. So, that makes for another, round of this when the IMF and World Bank can, convene in Morocco in October, generally in the neighborhood where all this stress is playing out. And it's unlikely that circumstances will have changed dramatically between now and then for most of these debtors.
Yeah, Dan, there's a question here too, which sort of riffing off it a bit. To what extent is the problem here in terms of inflation and what's driving interest rates is less about things like wages and more about profit margins? And the question here is that the people are making stock buybacks, they're reporting very healthy margins. Meanwhile, the Fed's embarking on demand destruction. So
certainly profit margins, they grew enormously over, particularly through 2022. There's and certainly they were a contributor to what we've seen overall in inflation. Now, there's an argument to be made on, from a corporate, leadership governance point of view. When you have your moment, you grab it, right? Now the question is the degree and speed with which those things get competed away. If you look at the US PPI series, the Producer Price Index series, there is a particular line item in there that is being closely watched by policymakers and others. That is a very good proxy for what's happening with margins. It's the retail trade margin and data within that. That is rapidly on the way to zero and going negative after having been at about 15% year over year through the middle of last year. That's a good indication that some of, and James Bullard, the St. Louis Fed president, who we've interviewed recently and had a number of conversations with, that's been one of his central theses about where they're going to get some help from outside, which is, those margins, as happens in any business cycle, you have an expansion. The expansion this time was extraordinary. There's no question. But eventually then a combination of softer demand and customers seeking accommodation elsewhere for their good or demand needs compete away that margin. And you look at that, and that's in the case of the U.S. at least, that looks like the salad days of really the fattest profit margins, and the degree to which they contribute to inflation look to be a bit of a rear mirror issue. Now, there's still a huge problem overall with services inflation outside of the housing sector, something that Powell and other Fed policymakers have harped on consistently for the last 6 months or so. That's not showing a whole heck of a lot of signs of improvement. We've got the headline figures in inflation have come down. 5% CPI in March, that was down a point. We'll get the PCE rating for March a week from this Friday. That's at 5 as of February. It's probably going to be in the down into the 4s. Courtesy to some degree of some generous year-over-year comparisons. And that's the figure that the Fed bases its 2% target on, right? So that's why that's such an important figure. But the core measures at both CPI and PCE have, they've gone sideways, right? They're not dropping. We haven't seen a meaningful drop in core PCE since November. And we're not expected to see one with this next reading, really. So there's some embedded inflation issues that really keep the hawks at the Fed on their A game. But that's going to be really the thrust of the debate. Unfortunately, with May, we don't get the updated views, the quarterly summary of economic projections that we got in March. That did show, without saying it, the Fed just told us they expect a recession, right? 0.4% average GDP growth for this year. Well, guess what? Q1's in the bag, and it's going to be probably mid 2.5%. You don't get to 0.4 from there. In the best case, if you did flatline at zeros for the rest of the year, that gets you close to about 0.6%. Not quite. So you need a couple of quarters of negative in there to get to that point. And they also expect the unemployment rate to rise a percentage point over, by the end of this year, from a really low level. 3.5%, lowest since the 1960s. But every point rise in the unemployment rate is 1.7 million lost jobs. So that's so the Fed is telling you, without actually using the word recession, that they expect some pain ahead in lost growth and higher unemployment.
Yeah, that's pretty stark. Buckle up. Elisa, we've only got a few minutes left. I just want another one from the floor. This is about actually UK inflation, and it seems like they've got a very, very tough situation on their hands, Elisa.
Yes, and I think there are a number of reasons that point to this. This number being sticky and being the highest in Europe. Supply chains, tight labor, of course, and tight labor, particularly being acute post-pandemic and post-Brexit, and that will take a while to resolve unless there are some policy shifts potentially in terms of freeing up bringing in more labor. So yes, the UK, I see some of the leading investment banks have put up their expectations for where UK interest rates are going to head. Sterling's been powering ahead. It does seem that the UK has a particular problem on its hands.
And it's the latest iteration of a particular problem, right, Elisa? I mean, it's been a particular problem for them since the Brexit vote. But right, you add in public sector strikes. The doctor strike is particularly worrisome. I don't know that it's an inflation aggravator, but it certainly isn't helpful to growth, right?
It is, and some of these labor discussions are still ongoing, right, with some of the biggest unions. So those those wage negotiations still have to kick in as well in terms of the impact they have. So yes, I think I'm not entirely sure how we get to the 2% forecast for the autumn.
Yeah, from 10 doesn't work that way.
Well, I've been harping on about this a little bit in the past, as you guys know, but I think one of the fundamental things about this year is also going back to the crisis point, right, is that we are fundamentally moving from a regime of low interest rate, low inflation environment to something that's not going to be that in the medium term, right? And if you are looking at something where money costs more than nothing, your business models and your investment theses that kind of worked for the last 10, 15 years are no longer going to work. And people who kind of predicated their sort of assumptions on that looking forward are going to blow up or not be able to survive. And so I think that's what we'll go through in the next few months. And that's where more things, which one of them turn out to be systemic.
And we still and we still have to see the sort of effects that will ripple across the world when Japan eventually gives up its yield curve control, right? And, all of the bond portfolios are sold off and foreign assets are sold off, and people start pulling their holdings and their cash back to Japan. And that will have a huge ripple effect.
Okay, look, on that note, I think I'm going to, I wish I could say a cheery note, but it's not that cheery. I wish everybody luck today, and thanks very much for tuning in, and thanks very much to our panelists as well. So I'll wind it up there. Thank you. Thanks very much.